Find out about landlord tax deductions next on Holy Schmidt.
Holy Schmidt!
Hi, this is Jeff Schmidt from holyschmidt.com. If this is your first time here and you're an entrepreneur looking for an edge to grow your business, to beat the competition, to maximize your tax advantages, or all of the above, make sure you hit subscribe below and ring the bell so that you don't miss a thing. Entrepreneurs are provided with a long list of tax advantages that just aren't available to employees of other companies. And real estate investors have all of those advantages and an additional list which is quite impressive. That list is what we're talking about today. In this video, we're going to talk about 9 different types of landlord tax deductions, a few of which you may not have heard of. We're also going to utilize the help of my brother Jack out in Arizona. Jack, why don't you introduce yourself to the folks here on Holy Schmidt? But not too many people know me, but for some reason a lot of people judge me. They said I was the least likely to succeed when I was in high school, and they said that I'd grow up to be a gas station attendant. But that hurts me. Hurts me on the inside. I tell you, you don't know me. You don't know Jack Schmidt, but you will. On this YouTube channel, you will. Every time I say that, they laugh at me. I don't know why. There are 3 types or 3 categories of property tax deductions. The first is tax deductions related to the property itself. The second are tax deductions related to the business of property ownership. And the third is the category of paper expenses. And we'll cover each one of those next. The first tax deduction is the paper tax deduction. Number 1, it's the deduction of depreciation. The reason it is a paper deduction is because your property, if the future looks like the past, probably won't go down and it may even go up over the time that you own it, but yet you can depreciate 127.5 of the purchase price of the property out over the next 27.5 years. So if you had a $275,000 property, you could write off $10,000 a year. But at the end of 27.5 years, your property would not be worth 0, more than likely. Number 2, the second deduction is maintenance and repairs. If you buy a house and you maintain it and you repair it when it breaks down over the course of the time that you own it, you should have a house that is in very good shape when you walk away and sell it to the next person. Maybe even as good a shape as when you bought it. Yet the depreciation deduction suggests that that house should be worth 0. Interestingly, you can deduct both the purchase price of the house with depreciation and the maintenance and repairs of the house together. So the IRS is saying, we want you to maintain that house and we want you to keep it in good shape for whoever is renting the house. Number 3 is interest on the loan used to purchase the house. Now this one's a confusing one for some because the Tax Cut and Jobs Act of 2017 capped the amount of interest that folks could deduct on their primary residence. But that doesn't have anything to do with investment property. There is no cap on the amount you can deduct in interest expense on your investment property. Number 4 is taxes. Now, the Tax Cut and Jobs Act of 2017 also limited the amount of real estate taxes that you could deduct from your tax return as a homeowner. But again, there is no limit to the amount of property taxes that you can deduct from your tax return. The only limit is the amount that you paid in property taxes. Number 5. Number 5 are your professional fees, your legal fees, your accounting fees, and your property management fees. All of these fall into the category of professional fees, and they are all 100% deductible. Number six, insurance. The cost to insure your property is 100% tax deductible, which makes sense. Number seven, the next category is your home office / utilities category. And basically this means anything related to your house or your apartment that you pay for that benefits the business in that office is deductible. Let me get really clear about what I'm talking about here. If you have a 2,000 square foot home and you have a 200 square foot office, then you can deduct 10% of a lot of your home related expenses as a home office expense. This is your mortgage. This is your utilities. This might even be landscaping as it relates to your business if people are coming over to see you in your home office. Importantly though, associated with that are the costs of what goes on inside the home office. Paper for your printer, ink for your printer, internet time, if you have an internet subscription, etc. Those are all related to your home office and those are all deductible. Number 8, there are other expenses outside of the home that you incur to run your business. A mobile phone, for example, is a big one. Your car, if you have a car exclusively for your business, then you have one type of deduction. If you use your car in your business, then you generally have a miles deduction. Make sure you talk to your accountant about which one is which so that you maximize the opportunity. Number 9, the last one relates to staff. Whether you have employees or you have contractors that work for you, the cost to bring them on board and pay them is a deduction. So there you have it, my top 9 list for you for landlord tax deductions. I hope you find this useful. Make sure you hit subscribe below and give this a thumbs up if you like the video so that others can see it as well. This is Jeff Schmidt from holyschmidt.com. Thanks for watching.